Housing's kind of stuck at the moment. I mean, there's no two ways about it. You've got rates very, very steady. You've got prices very, very high. And neither side wants to capitulate. The hope is rates come down, or the hope was, I should say, rates come down. But that's looking less and less likely this year, maybe a next year story. So do prices start to stabilize, or do you continue to see this kind of limping of demand for even longer?
My realtor called me up last night. Emily called me up, Paul.
Okay.
A small manse in Woodstock.
Yeah.
She said, she said, like a weekend, the stuff sells, just like in New Jersey.
Yep.
Like
Jersey
a
Shore.
weekend.
You betcha. Gennadiy, what happened to your market over the last couple of weeks as rates rose? What happened there? Was it technical? What's going on there?
I think it's a combination of technicals and just almost time decay. The longer we stay here, the longer this Iran issue remains unresolved, the more upward pressure you have on rates, because we're in this weird environment where, as you mentioned earlier, the economy is actually doing relatively well, and inflation's actually edging higher and higher and higher. Oil prices are high, but they're not at high enough levels to start to destroy demand. That would be probably past $120 a barrel, maybe $150. We're not quite there yet. The longer we stay here, by the way, the more likely that is to happen. Our commodity folks are looking for oil to shoot up to 150 if this kind of period persists. But right now, right here, the longer we stay here, the trickier it is. And you've seen the Fed pivot towards, a less dovish tone.
So, all right, if I'm this new Fed Chairman Warsh, I'm coming in. I kind of got a little bit of pressure to lower rates, but boy, the data just isn't there, is it?
I was going to say a little bit of pressure.
Yeah.
Warsh is coming in on the premise that, he is going to lower interest rates. I always remind people he's got to convince 11 other FOMC members that rates should be lower. He's not a one-man band, and it's going to be tough. You've got growth relatively decent. Maybe he can convince them to keep rates relatively unchanged as some of these hawkish expectations actually feed through. What we don't expect are rate hikes. And that's not a Warsh issue. That's a FOMC issue in general. We expect them to stay steady for longer. I don't think they'll be hiking rates unless they really see inflation not just remaining high, but actually threatening to accelerate. That, I think, would be the threshold.
I don't have a survey yet, but CPI June 10th. I mean, can you model out at TD Securities a 4% year over year?
It's not out of the question, simply because it really depends on where oil prices are, right? If we're talking about headline CPI, if we can, goodness forbid, we go back to bombing Iran, we'll see. We'll
I
see
don't do the parlor game, but you bring up the really good point, a la Mervyn King and times at the Bank of England. Are you beginning to model, literally, to be entertainment about it, a revolt at the Fed, where governors and presidents just simply vote down a Mirren-like Warsh?
I think so. I don't think Warsh will be very well supported if he pushes for lower interest rates. Let's put it that way. At least not in this environment. What he will push for is some reforms at the margin. Maybe less communication by the chair. The smaller balance sheet seems to be gaining a little bit of traction. But again, all of these things are, at least the balance sheet side, are relatively gradual. We're not expecting big balance sheet changes overnight. This is over the next couple of years. What can he do day one? Probably not a whole lot, especially not in this environment. But hopefully by the end of this year, early next year, as you get inflation under control, assuming Iran is somewhat buttoned up and resolved, you can actually see rates starting to drift a little bit lower as inflation comes off.
And the rising rates is not just a U.S. issue. We're seeing rates around the world go up. I mean, Japan, for example. I mean, so this isn't just a U.S. thing, is it?
Well, Japan, Europe as well, and the U.K., they are much more exposed over in Europe to higher energy prices than we are. Japan is on this very gradual path towards higher interest rates as well. Relatively gradual, I would say, in terms of the overnight rate, but the long end is selling off as well. So this is a global phenomenon. But again, it's this, we're caught in this really bad environment at the moment until growth actually keels over.
One final question. It's really important, and it's off your remit. And I say this, Gennadiy, with great respect. Michael Green writes a Substack and says, look, a 5.1% 30-year bond, shut up and buy it. Step in, buy it here. Tell me about buying the dip in bonds right now. Do you just buy, or are you looking out tenths of a percent of yield or greater?
I think it depends on your holding period, right? If you are a long-term investor, I think these are good levels. By the way, especially in real rates. I know you love to ask about those. Those are relatively high. Look at 30-year real rates. They're really approaching 3% at this point.
Yeah.
And that's a great long-term buy. The problem is conviction levels among investors are extraordinarily low. Nobody really wants to take the hit, especially now for the 6 months coming up into their year end. I think conviction is low. Nobody wants to stick their neck out. So they're stuck doing very little and markets are flailing in the wind. You're kind of seeing that in the price action where it doesn't take a lot to move markets 10, 15, 20 basis points here.